Looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. We have this first question from Betty, and Betty wants to know, what are the fees in my 401k, and how do I know if I'm paying too much in fees? Betty, this is a very important question regarding the fees in your 401k, how to assess it, right? So let's dive deeper into this understanding and how to understand and how to manage fees. They can significantly impact your retirement savings, especially when focusing on income and reducing risk. So first, 401ks typically offer mutual funds as investment options. Mutual funds come with several layers of fees. It's crucial to break these down to understand their impact on your savings. The primary fee is the management fee, which compensates the fund manager for overseeing the fund's investments. This fee is essential because it covers the research and decision-making involved in managing the portfolio. So that's a good fee, I guess. Now, additionally, there are administrative fees, which covers the operational costs of maintaining the fund, such as issuing statements and providing customer service. While necessary, these fees can vary widely across different funds. Now, one of the most notorious fees is the 12B1 fee, which is essentially a marketing fee. Now, this fee is used to promote and sell the fund to new investors. It's important to question the relevance of this fee to your retirement goals because, as you know, it doesn't directly benefit you as an investor. Now, the crucial question, how do you know if you're paying too much in fees? Well, one benchmark is to compare the total expense ratio, TER, of your funds. Now, this ratio includes all of these fees associated with managing the fund and is expressed as a percentage of your total assets invested. Generally, lower total expense ratios indicate lower overall fees, which can potentially translate to higher returns over the long run. If you're over 59.5, you might have the option of an in-service rollover to an IRA. Now, this allows you to move a significant portion of your 401k funds into an IRA while still working, potentially reducing the fees you pay. IRAs often offer a broader range of investment options, including lower-cost index funds and ETFs, which can help minimize fees compared to actively managed funds. Now, when considering professional advice, it's essential to find an advisor who prioritizes transparency in fees. While advisors may charge a management fee, these fees are typically transparent and can be compared directly to the hidden fees embedded in the mutual funds. Now, moreover, advisors often allocate investments into individual securities, which can offer more control over fees and potentially reduce costs over time. Now, in conclusion, understanding the fees in your 401k and assessing whether you're paying too much involves comparing the total expense ratio of your funds, exploring options like in-service rollovers to an IRA for fee reduction, and seeking transparent fee structures when working with financial advisors. By taking these steps, you can optimize your retirement savings for income generation while mitigating unnecessary costs. Now, always consult with a financial professional to tailor these strategies to your specific financial goals and risk tolerance. Great question. If you would like to send in your question, you can do so. You can email that question to poollocke@poollocke.com. Moving on. Second question of the day from Sandy. Now, Sandy says, we're getting close to retirement, and I think we should consult a professional or work with an income specialist. But my husband, who's an engineer and has been, doing DIY, doing it yourself for our investing for the last few decades, he says we don't need a professional. What say you? To answer your question about whether to consult a professional or continue with a DIY approach, especially with your husband being an engineer, brings up some critical points about transitioning to retirement and managing investments for income. Engineers like your husband often have a deep analytical mindset and a knack for problem solving, which can be advantageous in many aspects of life, including investing. However, there are nuances to retirement investment, particularly when focusing on generating income while reducing risk and volatility. First, engineers typically approach investments with a total return mindset, which focuses on both capital appreciation and income. This approach can work well during the accumulation phase, where growth is prioritized, but transitioning to retirement requires a shift towards prioritizing income first and growth second. The reason for this shift is straightforward. In retirement, your primary goal is to generate sustainable income to cover expenses without depleting your savings prematurely. Now, one crucial aspect your husband might consider is the source of income. Income derived from capital appreciation of investments, such as selling shares or stocks of funds, can be unpredictable and risky. It's essentially drawing down principal, which can be unsustainable over the long term, especially if the market experiences downturns. On the other hand, income generating from interest and dividends is more stable and predictable, providing a reliable cash flow stream. Now, regarding whether to seek professional advice or continue DIYing it, here's a perspective to consider. While your husband may have extensive knowledge and experience in engineering, navigating the complexities of retirement income strategies requires specialized financial expertise. Just as a football team might need both an offensive and defensive coordinator, your retirement plan could benefit from the insights of an income specialist. An income specialist can provide valuable guidance in structuring your portfolio to maximize income while minimizing risk. This includes strategies like diversifying across different income-generating assets, such as dividend-paying stocks, bonds, possibly annuities, depending on your risk tolerance and financial goals. They can also help navigate tax-efficient withdrawal strategies and ensure your investments are aligned with your long-term income needs. Furthermore, a professional advisor can offer a broader perspective on market trends, economic conditions, regulatory changes that may impact your retirement income strategy. So this broader view can help mitigate risks and optimize returns over time. So wrapping it up, while your husband's DIY approach has likely served you well in accumulating savings, transitioning to retirement income and retirement income planning involves different considerations. It's about ensuring your savings, your savings work for you efficiently and sustainably throughout retirement. So consulting with an income specialist can provide the expertise and tailored strategies needed to navigate this crucial phase of life with confidence. It's an investment in peace of mind and financial security for your retirement years. So that was a great question. I love working with engineers. As always, if you'd like to send in your questions, you can do so. You can email them to poolelock@poolelock.com. And if you like what you heard today, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.